Good afternoon. You're watching Business World Live. I'm Jes Delos Santos. Let's take a look at how the local bourse closed today, Thursday. Okay, it's been a downward slope for local shares from the get-go on Thursday's session. The index raised gains made on Wednesday with a 1.6% decline back to 6,727.93. Now, Philip Hagedorn of ATRAM will take that rather than sit at 6,000 during this morning's broadcast. He noted how there's still interest from foreign investors, especially after Mondinison's IPO. But it's been 9 straight days of net foreign selling, with sales today at 551.1 million pesos. Now, Hagedorn has high hopes that the third quarter will bode well for the markets, considering that mobility numbers are up and vaccination is expected to speed up further. But at least today, things not looking up for most stocks. URC exceeds the main bourse's sell-off with a 4% decline, while a majority of stocks from Ayala Corporation all the way to Aboiti's Equity Ventures, as you can see in this chart right here, these stocks are down by more than 2%. On the upside, Bloomberry bucks the sell-off, gaining 2.6%, followed by DMCI, which is up by 1.9%. Now, a look at some individual stocks. Let's kick things off with Shakey's. They are planning to add 30 stores to their network this year, half of which will go, of course, to their pizza business, while another 15 will go to their peri-peri venture. They're already at one-third of that target, with 11 stores already opened as of May this year. Now, the resto operators said they're on track to recovery, but will remain fiscally prudent. Now, their recently acquired multi-brand also has potential to be a market leader, at least according to its president, Vicente Gregorio. Shakes today in the green at 8 pesos a piece. That's a 0.25% increase from yesterday's close. And lastly, after a stock that's not exactly listed on the local bourse, well, at least for now, I'm talking about Oceana Gold. Well, this following, of course, the Philippine government saying that now it's going to require the miner to list on the PSEi as part of the mining agreement it inked with the country. Recall that the government has green-lighted the additional 25 years for the Didipio Mine Financial or Technical Assistance Agreement. Now, financial terms and conditions are unchanged, while giving additional benefits to hosting communities, including at least a 10% listing of Oceana Gold Philippines on the PSE within the next 3 years. The palace said that would allow the miners' operations to at least help create more jobs here and beef up local government's tax stake. Oceana Gold again is listed in Canada, where it saw shares increase by 4.4% at least during the last session. Here are other headlines we're keeping our eyes on. The International Labor Organization is working with the Japan government over a project aimed at bringing back jobs safely this pandemic. This comes after labor groups here in the Philippines complain that there is a lack of government aid for small business employees and informal sector workers. The project seeks to make MSME workplaces safer and more productive in time for more eased restrictions. This includes digitizing small business operations, providing training programs to employees, and creating more innovation hubs. The project will run for a year with a $2.2 million funding from Japan. Covered areas are provinces and non-metropolitan regions in the country at high risk of COVID-19 and those that lack financial support to boost employment. Now, local manufacturers of electric vehicles are open to exporting their products, but that's if they are provided with government assistance in securing bank financing. The Electric Vehicle Association of the Philippines says their members are focused on the local market, although they are willing to try exporting if opportunities are present. But the group says one big concern is the financing scheme. The association is hoping the finance department would tap commercial banks to finance more local EV manufacturers. The group insists capitalization plays a significant part in their move to offer Philippine-made electric cars to the export market. Now, the central bank continues to keep an accommodative stance in monetary policy, saying actions would remain supportive of the economy until recovery stabilizes. BSP Governor Ben Diokno said monetary policy will remain guided by inflation and economic outlook and won't be affected by external factors. In an online briefing, Diokno said the economy will recover this year on the back of vaccination rollout and the country's virus containment efforts. Diokno says that the Philippines is still in favorable position to withstand external shocks and that a rise in debt to GDP ratio is inevitable given the pandemic. Recall that Fitch Ratings revised its outlook on the country to negative. Its Asia Pacific Sovereign Team Associate Director, Sagarika Chandra, told us yesterday that increasing debt to GDP ratio would be a key factor they're watching in determining credit rating action. Meanwhile, the BSP has approved a new 540 billion peso loan for the government after repaying a similar amount back in January. First Metro Investment Corporation is joining the slew of growth projection cuts for the year as they see the economy mending slower than expected at 5 to 6%. Now, to better make sense of their outlook, we have on the program UA&P Executive Director for Strategic Business Economics Program, Dr. Vic Abola. Good afternoon, Sir Vic.
Hi, good afternoon.
Okay, sir, first, give us an idea what drove that 0.5% cut and what's it going to take at least to turn things around?
Well, the lockdown that was done in the first quarter was unexpected because that was due to the surge of in COVID cases, and that made businesses cut down again because there was already some momentum by December, even until January. However, the lockdowns at the end of March and on to the second quarter meant that that -4% will have a big effect on the full year forecast that we had. It's a slight, I mean, it's not, which we were already a little bit on the low side of the government's target, but that thing of stop and go does not make it easy for business to get back into shape because it's it's not easy to reboot your operations if you have closed it. You have to look for people again, unless you may have to call them back from the provinces. That's what happened with the construction industry, and so on. It's that's why the impact would be still felt in the second quarter. Um, it's quite nice to see if we're coming from a low base, but if you look at it quarter and quarter, then maybe in the second quarter would only be slightly better. I mean, better than the first. We really don't expect a very big jump in the second quarter. Yes, for the third and fourth, yeah, you can see acceleration. That's
Mhm.
why we still stick to the 5 to 6% the growth for this year.
But do you already have at least an exact projection for the second quarter?
Yes, I'm projecting around 3.5%
Mhm. Mhm.
growth, positive one, from
Mhm.
-4.2 in the first quarter.
But Sir Vic, of course, one of the big concerns nowadays, of course, would have to be the Delta variant. And if we prove to be at least vulnerable to that for a particular contagious variant and lockdowns ensue, then how is that going to affect growth forecasts as well in the future? How much of
Um,
a cut would it at least yield in your projections for the year?
since we are really talking about an acceleration in the second half, and I think that there's such a strong consensus that the economy should open up despite whatever variants you would have, because there are available treatments. we're just been made to believe by mainstream media abroad that there are no viable treatments. There are, and that's been shown in 60 more than 60 studies, randomized studies for ivermectin alone. That's for ivermectin, but there are others like hydroxychloroquine and dexamethasone, and others that are also effective, but maybe not as effective as ivermectin.
So do I take it to mean, Sir Abola, that the Delta variant shouldn't be that much of a concern when it comes to at least economic growth?
Well, yeah, for the second half of the year, I think people are really already reeling from the overextended lockdowns, and they simply are will just go ahead, and then you know it's already a matter. It's now a matter of life, and that's not from the virus, but from your income.
Mhm.
So I think that we'll be seeing more people take their chances and go for early detection and medication.
Now, but given that, is the 6 to 7% growth projection by government for 2021 already an ambitious feat at this point?
Yeah, that's why we are a bit lower than them. No?
Mm-hmm.
There's a downside, still a downside risk, but that's practically only slight downward risk to the range that we've given.
But what are at least the sectors here that we should be banking on, which are our growth drivers at this stage?
Well, of course, we're backing on the infrastructure spending, which goes to public construction. But we've seen also very good numbers for exports, and as the global economy is recovering, of course, exports will tend to grow, uh, even though part of that may be offsetted by the elevated crude oil prices. But in terms of volumes, which is what we count in GDP, I think we'll have a very significant increase in the external account.
Mhm.
Domestic demand remains a question mark for me because I'm not quite sure that people will be going back spending like there was no tomorrow, or like there was no yesterday. It's just that I think people one, they have less income. Second, they will be more conscious of their spending, so that they'll be saving a bit more for the possible, uh, just in case for health reasons, what have you.
Okay. Now, Sir Vic, FMIC is also projecting outstanding debt to rise to 62% of GDP this year and even increase to 66% come next year. Now, should this be a cause for concern, especially in light of that outlook downgrade from Fitch?
Well, it is not in the danger zone yet. We were there once upon a time during the GMA administration. Uh, but if we grow faster, then if we really are able to accelerate our growth, you that will flatten and will even tend to go down, because the rule of thumb here, it's not the rule of thumb, it's actually derived mathematically, that if your economy's growth rate is faster than your real interest rates that the government's paying for its debt, then you'll have a tendency to for your debt ratio to go down, and that's what we are banking on. That by next towards the end of next year, we will be back on track and uh, really getting that growth, getting at a faster pace.
Okay, so you are at least expecting pre-pandemic growth by the latter half of 2022.
Yes, that's right.
Okay, thank you very much again for your insights. That was Dr. Vic Abola, Executive Director for Strategic Business Economics Program of UA&P. Thank you, sir. And those are the biggest stories this trading day, July 15, 2021. Catch Business World Live again tomorrow at 9:30 a.m. for the market open and 3:15 p.m. for the market close. I'm Jes Delos Santos. We are One News. Mask on, wash hands, and stay safe, Philippines. Okay na ba? Totoo?
Kamusta kayo?
Oh, hindi ko na-play. Wala akong narinig na nag-play ng ano.
Oxford. Baka naka-off yung mic.
Nagka-problema lang daw sa internet ni Aryan pero nakuha na ng e-stop. Okay.
Dr. Abola.
So nakatulala lang ako. Diyos ko.
So they're still alive.
Oh.
The pros, the dogs.